Bond yields are still hitting fresh 16-year highs, causing sell-offs across markets. This analyst is warning our exchange could be next in line.
So in our view, it is sort of a bit of a standoff at the moment. You can get anything from 20 up to over 30% overvaluation of the current sort of yield universe, which I agree doesn't make you feel extremely comfortable. We do not expect that degree of sell-off by any stretch of the imagination, but we have pretty much no meaningful outperform ratings. But it does look strange to us a little bit how little the equity market has reacted to what's happening in the bond market.
It's Monday the 9th of October and you're watching Markets with Madison. Long-dated bond yields are still pushing higher, with the US 10-year Treasury note breaking a fresh 16-year high this month. I spoke about this bond yield blowout on the show about a month ago, but in this episode, I want to draw your attention to a potential domino effect. Forsyth Barr is raising the alarm that yields of this magnitude could cause a double-digit decline in the value of the New Zealand Stock Exchange. Let me explain. The NZX is among the most interest rate sensitive stock markets in the world because it's filled with equities tied to real assets like commercial property, ports, telcos and gentailers, all of which tend to have long-dated stable cash flows, making them sensitive to long-dated bond rates. For the past 4 decades, investors in these stocks have done well as longer bond rates fell. But this month, the likes of the US 10-year hit its highest level since 2007. One fund management firm says that suggests the bull run for the NZX is most likely over, and valuations could fall further, potentially by 10% or more. Well, Forsyth Barr Director and Senior Equity Analyst Aaron Ibbotson has run this research. Thanks so much for coming on the show, Aaron. We look pretty exposed here.
Basically, as you point out, New Zealand probably has, at least of the sort of developed world, the most exposure to interest rates of any market. And as you say, roughly half of our index is full of very interest rate sensitive defensive yield stocks, as we call them. And the New Zealand bonds has also behaved sort of even worse, depending on your point of view, than the US ones, as you mentioned. So we've seen interest rates go up almost 500 basis points over the last 3 years, if you look at the 10-year, and another sort of 50 basis points or so over the last month. And to your point, the bull run sort of started being over maybe a couple of years ago or 18 months ago or so. But clearly, if you look overall, particularly on the yieldy part of our market, so half of our market, there's still a long way to go if we're going to go back to historical relationships with the risk-free or the 10-year.
Yeah, can you talk me through exactly how something like the US 10-year Treasury yield, how that moving higher directly impacts the NZX?
Well, I guess it is in 2 steps, but the main one that the New Zealand market is trading on is the New Zealand 10-year, but that in turn is very well correlated with the US 10-year. So, we've seen them move up and down in lockstep for many years, but, certainly over this during and post-COVID period, so say over the last 6 or 7 years, they've been highly correlated. So the New Zealand 10-year has moved up together with the US 10-year. And to put it super simplistically, investors has a choice, no? They can either buy fixed income, or they can buy some of these very defensive infrastructure names like the REITs, like the gentailers. And historically, you can quite see, you can see a very stable relationships, 200-300 maybe basis points or 2-3% higher dividend yield on these defensive names versus the 10-year. Now that difference has shrunk pretty much to nothing. You can look at it in different ways. You can look at valuation multiples. If you've got very low interest rates, you get a very, very high valuation multiples, obviously. But over the last sort of year or two, as the interest rates have gone back from 1 or 2% up to over 5 where they are today, that relationship has pretty much totally broken down. So, it could be, it doesn't have to mean that they're very expensive. It could also mean that, we're going to see much higher growth, for instance, inflationary growth in these names. Or it could mean that, the broader equity risk premium or market risk premium that investors want for owning equities have gone down a lot. But both of those explanations sort of feel a bit far-fetched, to be honest. So in our view, it is sort of a bit of a standoff at the moment. The equity markets expect bonds to rally, to interest rates to go down. And the bond market is effectively telling us that interest rates will stay higher for longer. So, most likely something will have to give. Either bonds will rally and interest rates come down, or equity is set for a pretty bearish next 6 to 12 months.
So you're calling this a standoff, but you haven't actually seen evidence of it being a sell-off necessarily just yet. That's what you're saying?
Yeah, I mean, we see, if you look at the REITs, we've seen a bit now. So REITs are down, depending on which one you pick, but anywhere from 10 to 20% plus, which is meaningful, but not remotely as meaningful as what should be suggested by the movement in bond rates. But elsewhere, the gentailers, for instance, it is difficult to see any signs of a meaningful sell-off. Similarly, in the telco land, if you look at the likes of Spark and Chorus, so it is, or the ports for that matter. So we've seen some adjustment, but it is so far quite modest in relation to the movement we've seen in interest rates. And as per normal, the explanation is probably a combination of things. We are seeing much higher inflationary pressure. That is part of why interest rates are where they are. So it is quite likely that we may see some inflationary growth, particularly in a telco or in the gentailers, and power prices or electricity prices have gone up a bit. So it's not, it's not a mathematical formula that's going to work out, but it does look strange to us a little bit how little the equity market has reacted to what's happening in the bond market or in the fixed income markets.
So effectively, these stocks, they're exposed, but they're also cushioned, correct?
Yeah, well, they're exposed to interest rate moves, but they're cushioned to macro, and that's the reason why a lot of investors hold them. And it's a good point you raise. That's presumably why they've held up so well, because at the moment, which is highly unusual from an historical context, is we're seeing rapidly increasing interest rates in a deteriorating macro environment. So normally it's supposed to be one or the other. As obviously interest rates should be pro-cyclical. So when times are good, interest rates go up, and when times are bad, they go down. But at the moment, we have sort of the worst of both worlds for equities, which is interest rates going up, but macro deteriorating. So you hide in these yield names, but historically you're hiding in them partly because interest rates are going down. Now interest rates are going up a lot, so that's probably why we're getting sort of mixed signals from the equity markets, I guess.
So when you actually do the mathematical theoretic calculation and you plug the current 10-year government bond rate, whether that's a New Zealand or a US 10-year Treasury bond yield, and plug that into your existing valuation assumptions, what does it tell you about the potential overvaluation of our market broadly?
Yeah, I'm going to rephrase your question slightly, just to make me feel more comfortable answering it.
Please, go ahead.
But if I plug today's interest rates into what is a pretty strong historical relationship to multiples, then depending on stock and depending on historical time period, you can get anything from 20 up to over 30% overvaluation of the current sort of yield universe, which I agree. It doesn't make you feel extremely comfortable. We do not expect that degree of sell-off by any stretch of the imagination, but we have pretty much no meaningful outperform ratings in that sort of yield universe at the moment, and we've got quite a few which we have underperformed.
Okay, so a 30% overvaluation obviously suggesting that we're not going to see a sell-off of that kind, but it does suggest that we are due for some sort of correction, right? So what would be a realistic number if we were to actually see something realistic play out?
Well, it can correct in different ways, no? So that gap can close, in one in three ways, no? So you can see interest rates moving down again a bit. You can see earnings being upgraded, or you can see the stocks correct. So if you talk, say, 25% without sounding too scientific, maybe you do a third over the next 12 months or so, but it's quite comfortable to see something like a 10% downside for sure of that group of stocks overall, which is not great for the index. We do not have a forecast per se of the index, but if I talk broadly, how you could see a correction play out, it certainly feels like there's a lot more downward pressure than upward pressure on this group of stocks.
And over what sort of time frame would you expect anything to that degree to play out over? Would it be until rates actually start being cut?
Yeah, so I think stocks never move overnight, and they never move in direct correlation to one indicator. But broadly speaking, as long as interest rates are not moving down from here, I think there will be some downwards pressure. So, when will we see interest rates actually start to move down? Well, maybe a year away, something like that, or 6 to 12 months, towards the back end of 24, calendar year 24. I think it is very difficult to see a meaningful change before then. During that period, if interest rates hold where they are, you could see a continuous pressure down, I think, for this group of stocks. We have other things happening in between. There's always a lot of different things. We have an election coming up that could jolt certainly a certain group of stocks. We have what's going on in the US, obviously, is always quite meaningful, global macro, etc.
So obviously we haven't actually seen a sell-off of that scale. Does that mean that the market is wrong?
Well, the market is always right, but it does seem a bit optimistic, in our view, particularly in this group of stocks, as discussed, and there's a lot of moving parts, and liquidity is one. You need somebody to sell for stocks to go down, and these stocks are not necessarily very liquid, or at least a whole bunch of them, which is also potentially why we've seen some weakness in a couple of ones which are wildly held offshore, like a Spark and Chorus, which have been weak recently. So it's I don't want to necessarily say that the market's got it wrong. It's easier for me to say that I think sort of the risk reward looks unattractive, but certainly the market hasn't factored in the big move in interest rates in how they price these assets. It is difficult for me to understand why fully. At the same time, a lot of investors wants to or needs to be fully invested, doesn't want to necessarily go to cash. The market has corrected a bit. If you think about, it has moved down 10-15% from the peak for a lot of these companies. So It is a hard call, and as I mentioned earlier, it is a very unusual situation where you have interest rates going up, but macro deteriorating. So there's an element of you need somewhere to hide, and at least earnings are not being downgraded for these stocks.
Well, the standoff, I'm sure, will continue. And when it turns to a sell-off, you're the first person I'm going to call, Aaron. So thanks so much for your time.
To be called Dr. Doom here. That's not at all the case. But anyway, thank you for having me.
Yeah, what's that Einstein quote? In theory and practice are the same, but in practice, they're not. Something like that. But if it does happen, you heard it here first. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.